My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today, zooming in from just outside of New York City, we have a very accomplished real estate entrepreneur who is in the commercial space. She's Carly Iacono, and today we're going to be talking about triple net lease properties or net lease properties and what that's all about, what the big advantages are to this asset class, how it works, and why you might want to consider it. So Carly, welcome to the show.
Thank you, Dave. Great to be here. Really appreciate the opportunity.
I forgot to mention you're a fellow podcast host as well.
I am,
right.
yes.
Great. So Carly, give us a little snapshot of what it is that you focus on when it comes to real estate and helping investors get a better return on their money.
100%. So I lead a team that sells net lease properties nationally at CBRE. And net lease, for those of you that are new to the asset type, is this fascinating piece of the commercial real estate market where you have usually a national tenant who is paying all expenses, taxes, maintenance, and insurance in addition to rent. So why that's so interesting is it allows a purely passive investment vehicle that you can be part of no matter where you live and no matter what your experience or lack of experience is with commercial real estate. So think of any national company when you drive down the street. Could be a CVS, could be a Wendy's, could be Home Depot. Those are all investment properties, and 99% of the time, they are net lease assets.
So dumb, very simple question for you, Carly. Why do these big guys like Home Depot and et cetera, lease instead of just buying the property themselves? Especially if they're going to be there for a long time.
And they are. And some of these leases will be 50, 75 years long. They're very, very long when you include all the options. So it's a great question. And it all comes down to taxes. So a lease is an operating expense for a business, whereas real estate is an asset that you can depreciate, but you cannot write off all of your real estate as an expense. So from a corporation perspective, it's more advantageous to use your lease as an expense than to own the real estate. So there's very few companies that own their own real estate in the US.
So I'd always heard that McDonald's was one of those companies that owns most of their real estate. Is that true, or is that just baloney?
Yeah, no, you were spot on. McDonald's and Walmart were the two, I'm not going to say holdouts, but two of the biggest property owners. And they both are doing what's called a sale leaseback, where they actually sell the real estate they own and keep the lease. So they become their tenant of the property. So they're divesting of the real estate and staying on as the tenant. They still own a good bit of real estate, but that is changing.
And I'm just wondering if they've set up a separate corporation to be the owner of that real estate, or if they're actually selling it to real estate investors.
They're selling it to investors primarily. And that could be everything from a pension fund, a real estate investment trust, or an individual. It's a very wide gamut of investors.
So maybe kind of walk us through this whole sale leaseback thing, different kind of deal structures that you have with triple net.
Yeah, so sale leasebacks just simply means that the tenant owned the real estate and they're selling it and they want to stay on just under a lease scenario.
So it's just like the McDonald example that you were giving a second ago. Yeah,
exactly. And most of the inventory that you'll see in the market is not a sale leaseback. It's a separate owner who either had a build to suit property, meaning they built something for that tenant to their specifications, or they've traded and it's a private owner who's just traded the asset like you would trade a stock, right? Or other real estate investments. Sale leaseback only comes into play when the real estate is owned by that company initially and they want to divest of it and stay on as a tenant.
Okay, very, very cool.
Hopefully I didn't lose too many people there.
No, I don't think
you've
explained it very, I was just thinking, because there's a variety of different strategies with net lease properties. So what are some of the other ones? So that's the sale leaseback one. What are some of the other more common ones?
So just a standard triple net lease is what you'll
Hmm.
see most of the times. And again, that's where the tenant pays you rent monthly, and then they pay the operating expenses, taxes, maintenance, and insurance in addition to rent. You'll also see something called absolute net. In that case, all capital expenditures are also covered by the tenant. And that is your roof replacement, parking lot replacement,
Hmm.
structural repairs, things that are not maintenance, but capital or structural improvements. Those are taken on by the tenant as well in an absolute net lease structure. So there's a few variations of what these deals look like, but
Hmm.
in essence, just think of it for those of you that are new, that it's an asset where you're getting rent, but also your operating expenses covered along the way.
All right, very cool. So it's sounding like an absolute dream come true, home run in the real estate world. There's no such thing as that. So what are some of the pitfalls or the downside to triple net lease or net lease investing?
Yeah, so some of the pushback we hear is one, the returns are lower. So most things in investing, whatever type of investment you're talking about, is risk reward. So
Hmm.
if you have something with, let's call it a corporate tenant under a 20-year absolute net lease, that's going to be a lower return on your investment because of the security in the deal. So they're really designed for set it and forget it types of investments, not someone who wants to come in and work the asset to have the upside. Someone who says, I want to put my money somewhere I think it's going to be safe long term. And maybe I'm getting 5.5%, maybe I'm getting 6%, but that's going to be stable along my whole period. So that's one of the negatives. If you're looking for really outsized returns, it's not the right asset type. The other thing we hear is it's a typically a single tenant freestanding property. So
Okay.
if you buy something that's maybe a riskier company, and they end up going bankrupt or they vacate, that's your only tenant at the property. Unlike if you had a shopping center, you have a diversity of tenants, right, to carry the cash flow during your whole period. Now, the counter to that is these are large companies, you're going to know if there's stress, if there is changes to the business model long before they vacate your property in basically every scenario. So it's very unlikely that your tenant leaves and you're surprised. These are not
Mm.
small local tenants. But that's one thing that you want to get ahead of because the value is very much predicated on the tenant and the lease term. So if you have, let's just say it's a CVS drugstore, investment grade, corporate guarantee, publicly traded tenant, billions and billions of dollars behind your guarantee on your lease. If they were to leave, you're not going to want to sell your building vacant. It's not going to
Right.
have the same value. So then you're going to want to take time, work with a leasing broker to backfill that investment with another commercial tenant to make sure that your value is where you want it to be before you would consider selling.
Yeah, I've seen that firsthand with some commercial owners that vacancies can go on in some cases for years in certain locations, which is just absolutely gotta suck. So what are some of the things that you help your owner clients with when you're helping them to lease out a property like that? How do you can't completely fast track it, but what do you guys do to try to get it leased out properly faster?
Yeah, so we don't handle any of the leasing. It's
Oh, you don't.
interesting
Okay.
that the
Yeah.
the leasing is a whole nother part of the commercial real estate market. So just like there are brokers like my team that represent buyers and sellers, there are landlord representatives and national tenant representatives on the leasing side of our market. So if we have an asset that potentially we sold to a client, it could be a decade ago. We stay very close to our clients post sale. If there's an issue or we think there's future weakness, we'll go ahead and help them find the right leasing team with the right expertise in that market and connect them before there's a problem to try to get ahead of what that next step will be. And it's very specialized. There are some brokers that just focus on big box like Walmart and Best Buy. There are some that just do fast food. So finding the right resource in the right market is something that we're good at, and we help put all those parties together if there's a need.
Yeah, that makes a lot of sense. So for people that are kind of thinking about this asset class, realistically, when you're looking at newer investors getting into this, not the folks you've been working with for decades,
Sure.
but newer investors getting into this, what are some of the assumptions or myths that you kind of have to dispel when they're coming to you about buying their first net lease property?
There's a lot of different things that go into evaluating the quality of an asset.
Hmm.
We have clients who come to us and say, I really hate Taco Bell. I don't like fast food. I would never buy one of those. Or Starbucks has too much sugar in their drinks. I don't want to own one. Just things that you're like, okay, I
They wouldn't
understand.
drink it or eat it, so they don't want to
Right.
have it.
You
Yeah,
may not like eating there, but that does not mean it is a good or a bad investment, right? So take your personal preference for where you like to shop and what you like to eat and put that on the side, right? That's
yeah,
not one of the things that we consider. We do consider overall trends in the business models, though, right? Is this a concept in general that's in demand? Do we think that the prototype is going to stay consistent over, the next who knows market cycle?
yeah,
How do we look at the location? What are the now these are like standard real estate fundamentals that
yeah,
people will resonate with, but it's important here as well. How dense are the demographics? What's the traffic count? Are we at a signalized intersection? Is the market in the micro market, is it growing or is it contracting? Is population shifting or is it, coming into the market?
yeah,
So we look at the real estate fundamentals, the tenant fundamentals, the corporate financials of the tenants. We spend hours and hours tracking corporate financials to figure out where we think these businesses are going to make the most stable recommendations for our clients. So it's just a different mindset than if you were looking at, let's say, a home to rent out in your neighborhood or
right.
in your county. And I think the last thing I would point out is you can own these anywhere in the country, and your best deal may not be in your backyard. And that's kind of the beauty of it because you can diversify not only by tenant type, but by market because you're not involved in the operation of the real estate. So we'll have people who are new come to us and say, we live in Boston. We definitely want something in a 30-minute drive and let us know what you come up with. The answer is probably nothing at that exact moment in time, right?
Right.
Because the best deal could be in Arkansas. Um, it really just depends on where we find the best mix of all those things, the return, the tenant, the lease structure, the location, et cetera.
So for somebody newer to the space, getting into the kind of properties that you guys represent, I know it's all across the board, but just what's the range of capital that they're going to need to be able to bring to the table?
I would say starting point for an entry level deal is going to be on the low end about 1.5 million
Hmm.
and up from there. If you're over 2 million, you're going to be able to find some quality deals. Now that's not just equity. So typical loan terms are 65% loan to value. So you would need
Hmm.
35% down
Right.
comfortably. You're going to want a little more of a cushion for closing costs as well, because you're going to have an environmental report, a survey, title, all of your basic due diligence reports. So I'd budget probably another $30,000 to be safe for closing costs when you're buying a new property. Now, can you find higher loan to value? Yes, there are some credit unions doing 70, 75% loan to value, but it's rare and I wouldn't count on it. So I would say
Right. Very,
35%
very
down.
location specific as well, right? So,
Yes,
yeah.
exactly. You nailed it. It really depends on the market. It depends on the type of deal too, as to what the lender appetite will be. I would say 2 million and up is comfortable with 35% down.
Okay, very good. Now you mentioned one of the big pros to net lease investing is lack of need of management of property management. But I'm sure there still is, like if you've got somebody in Boston investing in a property in Arkansas, they're still going to want to have some boots on the ground there's probably something that could potentially go on. How do people manage these from a distance or manage the managers or how's that typically work out?
So you might be shocked to know that about half of our clients never see their properties, have never seen
Actually,
them.
I'm not shocked at all.
Yeah.
I could believe it.
They'll buy them and sell them and never see them. So we recommend it's good to go see your property before you spend, a few $1,000,000. But the reality is, if it's a true triple net, or even better, if it's an absolute net lease deal, there's nothing for you to do once you see
Mhm.
it, right? You're not going to have keys because you can't just walk into your Starbucks whenever you want, right? It's a corporate Starbucks.
Yeah.
So if there was a concern, the tenant will notify you, because remember, they're the ones managing the property. They're
Right.
self-managed, right? And then let's say it's not true triple net and there's a roof leak and you need to deal with it. There are national providers everywhere. So then we would sort of simply get estimates, figure out what it was, send someone over there to meet with the manager of the store and have it taken care of. So you
So do
really
your clients continue to
don't need
work
to be
with
on
you
site.
and get help from you guys on those kind of issues if they come up?
They really don't come up that often, but yes,
Yeah.
we are always a resource. And if there's something out of market, that's why it's nice to work with a national firm.
Hmm.
There are multiple, not just ours, but having those resources and being able to touch every market is a nice benefit. And we're always here for our clients post close for anything that comes up. But the management is really very minimal.
Perfect, Carly. So as we're wrapping things up, I know we'll get your contact information in a minute, but I know you've got your own podcast, your own YouTube show. Tell us a little bit about what that's all about. If people want to learn more about this, I'm guessing that's a pretty good place for them to go.
Absolutely. So the podcast is called Commercial Real Estate Now. It is hosted on YouTube, but you can find it on all the podcast channels. And it's a mix of educational episodes, kind of like this content, but we dive in a little bit deeper on how to
Mhm.
analyze investments, how to handle 1031 exchanges, what retail categories are performing well, and so forth. And then we have one week where we speak with CBRE econometric advisors and talk about broader economic issues facing investors. And then we have another week where we co-host with a very large retail owner who is looking at things from the ownership side, and we go back and forth with what they're hearing with their own properties and their own tenants and give commentary that way as well. So it's a nice mix of content, and we're happy to have new listeners, of course. So please feel free to tune in and reach out if you have questions after any of the episodes.
Fantastic. Now, if people want to connect with you directly, what's the best way to do that, Carly?
Think I'm pretty easy to find with a Google search, but LinkedIn is one of my home base. You just type in my name. It's Karly, Carly Iacono, Iacono. Lots of vowels. So would love to connect on LinkedIn as well. And for anyone new, we do work with a lot of doctors and teachers and dentists and people who are very, very new to real estate. So if you have a simple question or it's just all brand new to you, feel free to reach out. There's a lot of resources we can send you as a follow-up.
Fantastic, Carly. Well, thanks so much for being on the show. This has been fun.
My pleasure. Really appreciate it. Thanks so much.
All right, everybody, take care, and we will see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.